This is Alan Bush with the Daily Financial Forecast for Tuesday, January 3rd. So, Happy New Year, everyone. We're off to a very good start already with stock index futures substantially higher this morning. Much of this linked to better than expected economic reports from around the world, including in the Eurozone, in the UK, in China, elsewhere in the world. So good gains, a good start to the new year. We continue to feel that even though the Fed is likely to raise interest rates 1 to 2 times this year, that stock index futures will continue to advance, since 1 or 2 rate increases, if we're right in that prediction, will not be enough to reverse this bull market in stock index futures. Over in the currency markets, seeing the dollar index sharply higher, this due to ideas that the Fed will be raising rates, with the Fed the only major central bank likely to raise in 2017. Also, the dollar being supported by news that the probability of a rate increase at the May meeting now has moved up to 40%. That compares to 33% that we had from late last year. Also, the dollar index higher, even though we did have some bullish numbers for the Eurozone with the employment numbers in Germany coming in much better than expected. Inflation also coming in quite a bit stronger than anticipated, which would normally be bullish for the euro currency, but apparently that news has been overshadowed by prospects of tighter credit from the Federal Reserve this year. Even the pound is lower, even though manufacturing numbers in the UK coming in at their best level in 2.5 years. So what is dominating is a hawkish Fed this year, taking precedence over all other fundamentals. So continue to look for the dollar index to trade higher in the first part of this year. And this is probably a trend that will last, I would say, probably well into this year as well. Now, moving over to the interest rate futures markets, we are seeing lower prices across the board. As we mentioned, economic reports around the world coming in stronger than expected. That a negative for the credit markets. Probabilities of a rate increase improving this year, also a negative. Plus we had commodity prices advancing with crude oil sharply higher, copper higher, other industrial commodities higher, all of which are bearish for the interest rate futures markets. So nothing changing in our long-term view here. Expect lower prices across the board in all of the major interest rate futures products, but especially in the 30-year bonds, which are most susceptible to inflation increases. So trade the bonds. In fact, all of the interest rate markets from the short side, but especially the bonds. And this is a trend that will probably continue well into this year. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.